Hello and welcome to the i3 podcast. My name is Wouter Klein and I'm the Director of Content for the Investment Innovation Institute. For more information about our educational forums for institutional investors, please visit our website at www.i3-invest.com. There you can also subscribe to our complimentary newsletter i3 Insights, in which we discuss investment strategy and asset allocation questions with asset owners around the world. Now, as you all know, we love our disclaimers in this industry, so here's ours. This recording is for educational purposes only. It does not constitute financial advice. Please enjoy the show. This episode of the i3 podcast was sponsored by Fulcrum Asset Management. As such, the sponsor may make suggestions for topics, but the final control over the podcast remains with the Investment Innovation Institute. Welcome to the i3 podcast. I'm here today with Suhail Shaikh, who is the Chief Investment Officer of Fulcrum. Welcome to the podcast.
Thank you very much. Thank you for having me.
So Suhail, we usually start with asking a little bit about the background of the guest and how they got into investing. Now you focus on global macro, absolute return. How did you get started in investing and why this specific strategy?
Sure. So I started my career interning at Goldman Sachs in 1999. I had done some work before that at a bank in the UK called NatWest Bank. And it all started there. It started on something called the intranet, which back in the mid-90s was predating the internet. And I spent a weekend learning HTML coding, got a job, and that job became my job for the next 3 years during finishing my school. Interned at Goldman Sachs. At that point, Goldman Sachs was clearly a big brand, and if you were good at maths and good at engineering, then often you went to one of these investment banks, and I would argue that Goldman is probably one of the best. So I applied there, got an internship, joined them. At that point, global macro, I didn't know what it meant. Absolute return, didn't know what it meant. I joined asset management. It could be at that time I joined a different group, but I happened to join asset management, and that's really where the serendipity starts. I worked in fixed income, I worked in equities, and very quickly realized I liked these top-down types of decisions rather than the bottom-up. And then that gradually led to my career being CIO at Fulcrum for the last 20 years. I did leave Goldman after 5 years within asset management, spent some time in New York, always working on portfolio construction, asset allocation, which are basically the key ingredients for global macro.
I think a lot of global macro managers have sort of fixed income at some time in their past because it seems to lend to that sort of bigger picture thinking. Was that helpful when you started looking into the global macro stuff?
It was helpful. I think the fixed income and currency background is typical of global macro approaches. Often it's because some of the most successful historical global macro traders have made a lot of their returns during equity market crashes. And they've made it in these bear markets by being right on the dollar or on commodities or on bonds and so on. And having established the global macro brand as something that is long volatility, that does well exactly when you need it, not in small market moves, they've kind of established the fixed income and FX as the core. Now, I worked in fixed income and FX for about 18 months of that first 5-year period, and it's definitely been helpful. But what I found is linking the equity market and the commodity market into fixed income and FX is more interesting and allows us to understand the world and the global marketplace a lot better.
Yeah. So looking back at history where people made their money in equity crashes, does that mean you wake up every day and you hope that the equity market is crashing?
Yeah, there is. It's an interesting one. Many macro investors tend to be known to be bearishly biased. It's not a fun place to be permanently bearishly biased. I do my best to not have any behavioral biases. The reality is that markets go up most of the time. And if you are permanently looking for the next big accident, then 9 out of 10 years or 90% of the time you're wrong. And either you may get depressed with it or your clients may get bored with it. So I try not to lose sight of the fact that we provide the greatest utility to our clients if we make them money when equities struggle, because most of their risk is in those asset classes that struggle, like equity and credit. So I try not to lose sight of that, and I have a very high threshold of trying to make money when those things happen. That's a core part of what we're trying to do. But I also am used to now, for the last 20 years, managing daily liquidity strategies that clients are looking at, ideally monthly, quarterly, but often daily. And it means that I don't have the luxury of waiting for the next crash to make money. So this is something that I've learned over time. It's important to make money while the sun is shining, so that your client is still happy with you and still holds on to you for when that bear market comes, so that you can then prove yourself. If you simply are a tail risk hedging strategy that waits for the world to blow up, unfortunately, or I guess fortunately from the world's perspective, but less fortunately from the hedging perspective, is you're often out of business before you get a chance to prove yourself. So I think it's good to have a good balance. So we've made money for our clients in each of the big crashes in 2008, 2020, around the pandemic, 22, when stocks and bonds came off together. But actually some of our best years have been in bull markets too. So that balance, I think, is good to get right.
Yeah, that COVID downturn was a relatively short and sharp one. Was that a very different experience for you compared to, say, the GFC?
Yes, I think in terms of returns, it was better for us. Macro investors need various things to happen. Typically, there are biases that are inbuilt, and I think some of those biases I have in my approach and my team's approach too. We like volatility, and the GFC saw volatility, but not in the rapid way that we saw it in 2, 3, 4 days around COVID. So the fact that volatility jumped very quickly as people realized how big an impact this could have near term, we were able to generate strong returns for our clients. And also the volatility jumped in one asset class, and then there was a half a day or 1 day gap before it moved from commodities to currencies to bonds. So there was an opportunity to change, take money off the table in volatility shocks and redeploy it and capture a new volatility shock. The GFC was different for a few reasons. Number one, I was 8 years into my career at that point, as opposed to 20 years into the career. So I guess I was less experienced, factually. The moves there were really starting in 2007, when credit markets started freezing up, and you started seeing accidents already. Volatility was elevated for almost a year before it exploded. And this is an environment where trend following was actually very beneficial, because many of the trends in terms of equities lower, bond yields lower, credit spreads wider, gold high, many of these trends were established before the Bear Stearns moment happened, before the Lehman Brothers moment happened. And so trend following did really well. And that's a second bias, I think, that many macro investors, including what we're trying to do, have. They tend to be long volatility, so benefit from shocks, and then they tend to like breakouts and trends. 2020 was much more about being there quickly. It wasn't about trend following, because the trends were moving in the opposite direction before the pandemic. So actually trend following didn't work well as a strategy in 2020. If I put 2022 into the equation, that was another interesting environment that was great for both macro and trend, because you saw a gradual pickup in bond yields and movement in asset prices that trend followers could really capture. Same with commodity markets. Meanwhile, volatility also jumped, correlations broke. That's another factor that tends to be good in macro. So volatility jumps, trends, and correlation breaks.
So it's interesting that you mentioned that momentum didn't work during the COVID crisis, because in the years before that, we saw that some, especially in the US, pension funds moved to this model where they called it a crisis risk offset model, where they basically were trying to build a sleeve of assets that were not correlated to equities. And momentum was a big part of that sort of idea of putting this in place. But then the COVID crisis happened and momentum didn't work. And it was sort of like, oh, does this model work? But it was basically because it couldn't react, I think, quick enough. So, but you mentioned you made some money during that COVID crisis. So what did work during that period?
This idea that momentum, trend following, CTAs, I think we're referring to the same price driven following prices. The idea that they provide crisis alpha, I think has some merit and has quite a lot of flaw to it too. It really depends on what the prior trend was doing. And as you said, in 2020, we had just come off a period of low bond yields and equity markets surging. So when the crisis hit, it didn't work. But I think that should have been known at the time, that trend following at that time could not have provided a hedge. It would have required the path to continue for a long time. Now, in reality, during the COVID shock, it was only a few weeks that equities crashed before turning. So actually, it was quite tough for momentum. Just as soon as they started turning to become short equities and long bonds, markets completely went in the other direction. So not an easy environment. So my advice, well, we invest in trend following. We have our own trend follower. And when I look at it, I know what its current positions are. And depending on what its current positions are, that's what determines whether there will be crisis alpha, not its historic correlations. I'll give you an example. We're talking in early March. Trend followers are confused in certain asset classes today, and they are more high conviction in other asset classes. So the dollar trend remains pretty firm, pretty strong, especially against the euro, cracking a little bit against certain emerging markets, but generally the dollar is strengthening quite a lot. Therefore, one of the biggest risks in trend following today is buy the dollar. I happen to like that view because I have, we as a group have views that the tariff risk in the US will be worse than the market is generally expecting. Maybe we'll talk about that later. Equities are still going up. Even with this slight shakeout that we've seen in equities, the trend is positive, not through the roof positive, but I'd say the average CTA is probably 45% long equities, maybe 80% long dollar, heavily confused on bonds because the yield is not trending. Remember, it's only a function of recent price action that drives those trends. Precious metals, gold, has been a big, strong trend for the last 6 months at least. Not 3 years because it's been chopping around, but for the last year, most of it, they're long precious metals. That's still there. Oil has been difficult. The Japanese yen has been difficult. But when you put that package together, it's a long equity, long dollar portfolio. If a crash happens out of nowhere, today, the CTA won't be convex. It won't be crisis alpha, unless the dollar really rallies strongly. But I think they will lose more money on the equities and the credit type strategies. Now, if it continues for 2 or 3 weeks and they adjust their position and the move becomes much bigger, then absolutely, I think you can get that. Now, to your question, sorry, it was a long answer to a slightly different question, but in terms of how we made money, a few things were really important to us. When COVID hit, we were looking at a lot of our models, our nowcasting models, our activity models, our inflation models, and so on, and we weren't seeing any problems, but at the same time, we are discretionary traders, and it was pretty logical that the world is shutting down. We can't wait for the data in a month to be revised, released, and then we figure out what's going on. So that's a sort of environment where we leave the models aside and we start thinking more as humans. We haven't seen this before. What can we look at? I was fortunate enough to have people in the team who are experts in single stocks, in equity trading, who were meeting company management. One of my partners, their head of equities, a chap called Fawaz Chaudhry, he was providing a lot of information directly from company management about the supply bottlenecks that they're seeing, about what they're doing in terms of slashing consumption, slashing expenditures and so on. That gave us quite quickly a real-time idea of how bad this could be. We were going to our researchers and modeling the actual virus data coming from the various agencies to almost nowcast that. So we have to adapt in that environment. And when you put that all together, it was only, I would say, 3 or 4 days earlier than many others, we started buying a lot of volatility. And so when the Japanese yen strengthened dramatically, when gold jumped before, there was two-way risk there. Equity puts, bond calls, we had a lot of those exposures in place. The strategy as a whole ended well. Vol jumped, trends worked, and we weren't reliant. We weren't reliant on the prior trends because we are discretionarily trading.
So you mentioned the nowcasting. Was that moment during COVID one of the first times that this really started to pay off? Because it's a relatively new trend, as I understand it.
So nowcasting is something that my again, another partner and investment committee member, Chief Research Officer Juan Antolin Diaz, has been building with his team, working alongside our chairman Gavin Davies, for the last decade. And these, maybe I'll just explain. Nowcasting is basically the idea is to synthesize all sorts of different economic data that is released on different frequencies with different lags, missing data, noise, synthesize it into a great estimate of today what is activity like. Because that's a good starting point of trying to forecast where it might go. If you can't understand where you are today, then it's not easy to know where you might be going. That was helpful to us throughout, I would say, 15, 16, 17, 18, but especially in the years from 18 to 20. In the pandemic, the nowcasts were not helpful, because the nowcasts in that pandemic, that is not what they're built for. The data is lagged. I would say in the inflation shock, our inflation forecasts and our nowcasts were again quite useful. So as human traders, as strategists, as thinkers, our job is to take the best of the quantitative modeling that we have and use our judgment and common sense to know when they might be missing something. Today's another good example where you've got executive orders coming from the US administration, from Trump, you've got tariff news, you've got fiscal responses to defense spending in Europe, you've got Doge in the US. They've got all these different shocks at play. And the nowcast doesn't know really about the tariffs. It can recognize uncertainty in the data. That's its job. It's to look at uncertain, volatile data and provide conclusions that filter the noise away and give you a signal. But at the same time, when there's a VAT hike coming in the future, or when there's a tariff news flow, or there's election, things like that in the future, you have to make subjective judgments on and overlay them on top of the nowcast before making conclusions. So it's part of the armory that we have, but I wouldn't rely on one thing.
Yeah. So today with artificial intelligence, is it easier to sort of make sense of all the information that comes to you under this nowcasting model?
Artificial intelligence, AI, is used in many different ways. I think computing power, cloud computing power in particular, the computational advances that we've made in the last decade make our jobs much easier. What used to be done by dozens of economists at big banks, including where Gavin had set up, we can do quite a lot of it with a dozen economists and a lot of machines and a lot of computing power. And that's what Juan and the team have really built. So I think that's much more about computational power, GPUs, than it is about AI. AI so far has been very useful to us, more on portfolio construction and risk management, on scenario analysis, stress testing, because there can be, take the example of the current situation where we're not just dealing with activity movements. There are shocks on activity, on inflation, on fiscal policy, on geopolitics, on trade, on defense, on AI itself is a shock. DeepSeek is a shock. Yeah. You've got all these different shocks at play at the same time, where even very experienced human minds struggle with a number of dimensions involved to figure out what could go wrong and how exposed would you be to this shock, how is it likely to perform in conjunction with others. I think this is where the simulation work that Juan and the team have been able to do on shocks has been really useful for risk management. I'm more skeptical about whether AI is yet in a position to be able to help with view taking and alpha generation and so on. I suspect that'll be a bit of an arms race like the high frequency trading became in the 2010 to 20 period, where you needed a lot of money to chase low and low latency to get close to the indices, to the exchanges and do the trading. That's not a game that we really want to get into, but the chances of getting real alpha signals right now, we haven't seen it. I think there's more hype than reality, and it all is really about the lack of data. If you're looking at 1,000 pictures of a cat, it's much more simple to know that this new picture is a cat. But when the Fed meets 8 times a year and you've got 30 years of data and their mandate has changed, or 50 years of data and their mandate has changed, we've got a few hundred observations for these sorts of things at most. It's not enough data to really learn. So we're somewhat skeptical. I think there's a lot more hype than reality there.
Yeah, I think in a recent conversation, it was talked about that AI is very handy for big data, but when you look at investing and time series, that's actually not big data. That's small amounts of data over a limited time span, where there's simply not enough points to have this work to its full potential. But where it might come into and more interesting is where you get so much information every day on economic indicators, on different views, to establish patterns where you quickly recognize, hey, this is something that is not part of the normal news flow, data flow, and that it can pick that out quickly and hopefully create more or less a signal, or at least something to look at rather than picking the right stocks.
I think that's right. It's there's no doubt that proper use of computing power with AI should be able to recognize patterns better than we can, because we forget things and it takes time. So I think pattern recognition, and as you said, that pattern recognition could be, this is an unusual dislocation because the last 3,000 times that the dollar has done this over this window, then gold has done that. So I think it'll be like exception reporting type analysis. Now, many of those strategies will, I think, potentially be profitable. I wouldn't necessarily say that's any different to the sort of quant models that are already being run. I don't think that's AI. That's about pattern recognition and just computational power.
Yeah, fair enough. So you mentioned a couple of times before behavioral biases, and perhaps I can take you a step back and look more at the philosophy behind your investment process. I think not too long ago you produced a paper, Fulcrum produced a paper that was called Don't Bet the Ranch. And one of the interesting things, and I think this is a very long-running discussion in the asset management industry, is the role of luck in producing returns. Can you tell me a little bit about how you think about luck in returns?
Luck is very important, more important for some managers than others. Some of the biggest managers have been very lucky. I don't think you can be very successful if you don't have a bit of luck. At the same time, one of the bits of feedback that I've heard repeatedly over the last 25 years, especially as I've met clients all over the world, is they don't know how to distinguish between luck and skill sometimes. As in, especially in macro trading, especially if somebody gets one or two big things right, I think it's impossible to distinguish between luck and skill if you are judging too few decisions. So the methodology that I've proposed, and it's not rocket science, it's what I use, it's what I would use in judging this, it's what I do use in judging whether the portfolio managers that I have in my team are skillful or lucky, is to understand how many different views did they take over a period of time. And before I make any judgment on skill or luck, I need at least, I would say, 25 to 30 views to know whether they were lucky or not. So if somebody had a view in 2008 that the US housing market was going to implode, and they were right, is that skill or luck? I think it's skill, but there's a huge amount of luck, because I know from personal experience, I thought the US housing market was going to implode in 2007, and I was wrong, and we lost money for a short period, and then we made it later. So depending on when, if you don't get the timing right, you're wrong as far as I'm concerned. So I try and judge managers, I try and judge strategies, at least 25 to 30, ideally hundreds of views, because it's very hard to be lucky if you've had 500 views and you've got 300 of them right, 60% hit ratio. That is very difficult. It's like think about the coin toss analogy. If you toss your coin once and you're right, does that mean you're 100% accurate? No, it's just part of the distribution. If you toss it 1,000 times and 55% of the time you get heads, statistically speaking, it's almost certain that there's a biased coin in your favor. That's the way I try and think about luck versus skill. And so in our longest standing strategy, we've had between 2008 and 2025, we've had about 700 different views. And I won't bore people with how to define a view in detail at the moment, but they need to be independent views. Long NASDAQ and long DAX at the same time are not independent. But long NASDAQ versus DAX may be independent to long Eurostox versus IBEX, for example. So we've had 700 views and we've got 54% of them right. There is no way that is luck. There's still a question as to whether that luck, that skill from the past can be taken forward in the future, because luck, your actual skill starts eroding. People start copying it, or you may lose your edge. Markets become quite efficient. But it's really an analysis of the trade by trade or period by period returns. That's the only thing I think you can do to understand whether it was skill or luck.
Yeah, that ability to repeat it in going forward. We come back to sort of, the usual disclaimer that you hear in the industry that past performance is not indicative of future returns. But I think in the paper you do describe that there is some information in past returns. As you say, you can look at the number of views and gain some information out of that. What is the role or the evidence that you gain from that past performance or past return patterns of stocks?
So not just stocks, I guess, across any strategy, what I glean from past performance is whether historically there is some skill, whether historically there is some asymmetry, i.e. are the winners bigger than the losers? But there's a lot of missing information also in past performance. So when I think about building conviction on a portfolio manager who joins my team and is running risk for our clients, past performance is less than 20% of the weight for me. Because unless I see how that performance was generated, unless I see how it's generated, I don't know the counterfactual of what could have happened if the view was wrong. So I'll take a very quick example, simple example. Let's say somebody sold S&P puts weekly 10% out of the money for the last 5 years, and then did some other random things in the portfolio to confuse me. And you end up with a return stream that makes money pretty much every week. I would see some correlation to markets, some positive correlation, but I wouldn't see a huge amount because we haven't had those events that often, especially if they've put a couple of other things in there. But I know I don't want that strategy. And it will have a great Sharpe ratio, and it has a massive bankruptcy risk depending on how much leverage is involved. But if I'm sitting with that PM and they're working for me with all full transparency, then I know exactly how that return was generated. It's a short vol strategy on the equity market. No, thank you. I can buy that for free if I want. Now, that's an extreme example. There could be someone else who's sitting in high-grade, high-yield bonds and capturing some risk premium. These things may have a role in a portfolio, but I don't want to pay for that beta alpha prices. Now, that thing, you can conclude many of these things from looking at somebody's past returns, but you can only have conviction, real conviction in how they've done it if you really understand the strategy. And in my case, I want to see it for a period, 18 months, 2 years in front of my eyes with our risk systems, with our risk oversights. And if you're still doing it, then that's super important. Related to that also, sometimes it's an institution that provides the information and the flow of ideas that generates a return. And if you take the person out of the institution, are they still going to generate the same returns? Now, that could be in one of these big multi-strategy hedge funds that the risk systems are so good that they help the underlying PMs. It could be in the old days in a prop desk that once you take a prop trader that's very successful within a prop desk, you take them out of that environment and they lose access to whatever flow of information that they had. Well, suddenly their past performance is not as relevant. So there is value, but I'm pretty skeptical about how much value I can extract from the past.
Fair enough. So you talked about the number of views being important, but in the paper you also touch on the hierarchy of views in the sense that the first ID is probably going to be a lot better than your 27th ID. How do you incorporate that into an investment strategy?
Sure. I think that something that I've believed for a long time is that conviction is the enemy of breadth. So what do I mean by that? If I have really high confidence in one view, by construction, if I implement that high level of conviction, if you take a Black Litterman type framework, and you say this trade is 10 times more conviction than everything else, it needs to be sized much larger. Not necessarily 10 times, but much larger. And that means if you're wrong on that, then game over. Because there isn't actually that much link between conviction and outcome. I think I try and be 60% convinced on something, not 90%. Now, I may size something more aggressively on a 60% conviction if there's a huge amount of asymmetry in the trade. The market thinks this is so unlikely. I think it's 60% likely. The market thinks it's 10% likely. Then I may size something in an option format and so on. But by and large, I like to have lots of small ideas, which is part of the reason why our returns are a bit more stable. We tend not to blow the lights out nor blow our brains out, right? Lots of small things. This is why the paper Don't Bet the Ranch. It's all about that. Yeah. And as I said, I can summarize it as conviction is the enemy of breadth. Now, that said, I know that some ideas I have a little bit more conviction than others. As long as the idea I think is going to work more likely than not, then I'm sizing them broadly similarly, whether it's 52% or it's a 58%. And I just don't believe something is 75 or 90. Then the real sizing is a complex topic. Often people look at sizing based on how big is your position, and they ignore how long do you intend to hold the position. Risk in a position is a function of a few things. How big is the position? Correct, people identify that. It also scales with the square root of time. So if you are in a 10% position in gold for 3 years, it's a lot riskier than a 20% position for 2 days, because in 3 years, a lot more variance can happen. The third thing is how volatile is the asset? Again, people will look at that. And the fourth thing is how correlated is it to the other positions? So I'm looking at all of these three things together, and I try and build a portfolio that has good breadth, but there are times where things, you just have better opportunities, you take more risk in them. So absolutely are willing to do that, but all within sensible bands and ranges.
Yeah. So you invest across a number of asset classes. What is the role of dynamic asset allocation in your process, where you take decisions not just based on an individual trade, but versus in correlation to other asset classes?
Dynamic asset allocation is more for the slightly long biased versions of what we do. So we have a strategy, Diversified Absolute Return, and 40% of its risk is in something we actually call dynamic asset allocation. It's a long only structure that is trying to decide how much equity, how much bond, how much commodity weight and risk should we have for an absolute return strategy. And there it's quite medium term. Because it's absolute return, we have to focus on vol. Maybe a quick note on that. Something I believe very strongly is a strategy needs the designer, the owner, the manager of a strategy needs to know, is it benchmarked or is it absolute return? A lot of the biggest accidents in asset management happen during drawdowns when people don't know whether they are benchmarked or absolute return. And I'm speaking from my own experience. I've seen that in 2008. And so the bulk of what we do is absolute return. There are versions that are relative return. And when you're managing absolute return, volatility is the only thing that really you should focus on. From a risk management perspective, volatility, VAR, downside VAR, CVAR, and so on. Whereas if you're looking at relative return, then it's tracking error and it's losses relative to the benchmark. A quick litmus test I often ask clients if they don't know is, if your benchmark's down 25 and you're down 18, are you happy or not? And if you're not happy, then you're absolutely not relative return.
Yes, that's a fair enough question. You mentioned how time horizons and holding periods are very important in trades as well, and the risk level that you take. Now, in dynamic asset allocation, sometimes this time horizon comes up in the question of, are you doing dynamic asset allocation or are you market timing? What's your view on that?
I think dynamic asset allocation is market timing. It's just a more fancy word for it. It tends to mean different things to different people. Often people have a strategic asset allocation. In my view, strategic asset allocation should be basically fixed. Maybe once every 5 or 10 years it's changed, but anything that ever changes, to me, to a degree, is hard to have a benchmark to it. But let's say 5-year changing strategic asset allocation. You then have dynamic asset allocation, which is typically changing how long you are each of the assets in your strategic asset allocation. And you don't typically go short, you're overweight or you're underweight. And maybe that horizon for many people is sub 3 years. For me, in our process, DAA is, I'd say 6 to 12 months, but it's assessed daily. Because of the volatility angle on absolute return, I can't wait and just ride out vol shocks and ignore them, because I need to make sure we don't lose a huge amount of money. But generally speaking, DAA, I would say, is in that sub 3 year. You then have TAA, tactical asset allocation. Some people think it's the same as DAA. It tends to be slightly shorter term. Tactical asset allocation tends to often, I think, can involve more shorting, more leverage. And this is where global macro, I think, typically sit. Global macro hedge funds, I think, are basically TAA funds that can be overlaid on people's asset allocation. And then you have higher frequency stuff, which I don't think comes into this. So I have views on this. If you're interested, I think TAA and hedge fund strategies should be left to experts who they're not necessarily better, but they're better equipped to exploit opportunities. They have ISDAs, they have the ability to use leverage. They're not constrained on being shorting. They can have turnover without the taboo. They can control their transaction costs and have that turnover. They can have real breadth of opportunity without having to necessarily go through committees and bureaucracy to implement the views. Trump says something dramatic happens. Sometimes you need to act immediately. Mm-hmm. So I think those sorts of strategies are left best to hedge fund managers or the like. I think if I were a pension plan or working with a CIO of a much larger outfit where these sorts of macro twists and turns are too micro, they're too small, then I would focus on the DAA side, where how much bond should we have? How much equity exposure should we have? Is this a covariant structure where commodities matter in the portfolio? What should be the constituents of the commodity portfolio? Should it be energy heavy or gold heavy? And there, generally speaking, because it's difficult to get breadth in those portfolios, just given the slow-moving nature of the decisions, I tend to think that they work better on a long-only level, i.e. save your powder, save your time, wait for distress in a certain asset and buy it, as long as you have the view that it's cheap and you have take advantage of your investment horizon, which is very long. You're not mark to market daily, and you have underlying pensioners or underlying beneficiaries who have a 30-year horizon. Take advantage of the fact that a particular sector is really distressed, and then leave the higher frequency, meaning weekly, monthly, quarterly type stuff, to people who are better equipped to do it. Not better. It's not about smartness. It's about breadth. And that, again, is something I explain in that paper. Hit ratio, asymmetry, and breadth. Breadth is about flexibility. It's about leverage. It's about turnover. Hit ratio is about skill. Asymmetry is about skill, right? But it's the disadvantage on breadth that is the problem often, and the difference between a low sharp and a high sharp.
If we take a look at one particular asset class, equities, we've seen last year quite a bit of turmoil in there. There was this issue with concentration in the markets, the Magnificent Seven. It made it very hard for a lot of active managers to produce returns because they tended to be on the way, the Magnificent Seven. How does that impact global macro strategies? Does that show up as well?
It does show up. I'd say in 2023, it's something that hurt us, we learned from it, and in 2024 it's something that we exploited and made money from. So what do I mean by that? When we look at global activity, US activity, you look at valuations, you look at what's happening in the macroeconomy, there is a link, and there has been a link between that and the US stock market, let's say, the European stock market. There is a link. For the last 2 to 3 years, especially as the AI boom really started ticking higher, then there was a different factor that was driving the stock market, and it was the Mag 7, not the non-Mag 493. And we did some work in 2023 because we kept getting certain things wrong, translating our macro views into the stock market, and it wasn't working. We started seeing a lot of noise, and we established that noise, or estimated that noise, to be this AI factor. And what we found is that our macro signals were translating into small cap, or into equal weight equities, or into the 493 much better. And so we started trading it that way, whereas there was a different shock that was driving these 7 or 10 stocks. In 2024, we were able to take advantage of that because we felt that even though growth was very strong in the US and inflation was going to be a bit sticky, the Fed would not cut as much as markets had priced. The dollar would go up. Normally when the dollar goes up, it's happening when equities are going down. But because of this AI frenzy, which we actually believed in, we believe it could actually, not the productivity side, but the fact that people would keep buying it. We're happy to ride bubbles occasionally. It's sometimes how you make money. I'm a believer in trend following. We believed that global stocks, US stocks, could go up with the dollar. And that was a pretty odd view to have at the time, because normally stocks up, dollar's weak. And so we could get a real good option payoff. And that was, again, understanding that the composition of the S&P has changed.
If we touch upon a bit more of an esoteric asset class, cryptocurrencies and Bitcoin. Now, I don't think you're going to invest directly into Bitcoin, but there have been some interesting approaches where people have been taking momentum strategies, trading futures over the Bitcoin S&P, where you have relatively confidence that at least the market is a stable market, the CME for futures, rather than the unstable markets of cryptocurrency. Is that something you would consider?
It's definitely something that we have thought about, not considered seriously. I think if I talk about it intellectually first and then from a practical perspective, trend following works generally, and it works because, or this is momentum trading, works because people like to buy what's going up. There's a fear of missing out, and they like to panic, or unfortunately panic when things are going down. So markets tend to overshoot. Information isn't absorbed, isn't disseminated and absorbed instantaneously. So I think trend following does work. It also is guaranteed to hurt at the turn, but I think it makes more money when during the trends than it loses during the whipsaw periods and the turns. So we trend follow cocoa, and we trend follow zinc, and we trend follow gold and dollar, yen, all these assets. I don't think Bitcoin's any different. I think, if anything, it's a sort of asset that is probably quite prone to retail-driven trend following and fear of missing out. So I think from a conceptual perspective, there's no reason, if I was completely unconstrained, why we would not trade crypto from a trend following perspective. I have looked into it a lot to understand it. I just don't understand it enough. I know some very smart people who think crypto is fantastic, here to stay. I know some very smart people who think the opposite, and some of them at central banks, some of them are at hedge funds. I don't understand it enough. I don't like to invest in something that I don't understand. So we don't invest in it. But also, many of our clients have forbidden us to invest in it.
Okay.
So that makes it relatively straightforward. We still need to think about it. So I will trade gold at times, or the S&P or the NASDAQ, because of a signal that we get from crypto prices or dislocations or volatility. So it's absolutely part of the universe of things that we monitor. But I don't anticipate trading it anytime soon. We have our client, it's not something that our client base generally wants us to be.
Yeah. So some clients have specifically told you not to invest in that. Yes. Is that because of the speculative nature, or is there a sustainability issue there? Why do they screen it out?
It's a variety of reasons. Again, sometimes it's, well, this asset class is so there's 3 or 4 specific clients, enough and big enough where we don't want to do it for the others and not do it for them. It's just not a market that is big enough and interesting enough. Also, we manage almost $8 billion. At our sort of trading style and frequency, until recently, I don't think the market was big enough for us to really do anything interesting in that market. But some have been sustainability related to the energy usage of mining, the cryptocurrencies. Others have been just don't understand it and it's speculative, and somebody on the trustee board had said, I don't want crypto, and that filters down and therefore no one gets crypto. I think as the ETFs have launched, as it's becoming a bit more mainstream, as certain sovereign wealth funds are buying it, then at some point this may all change. There are enough areas for us to make money and trade. We don't want to be speculating in the crypto market. It's not enough of a return opportunity. If I really understood it well and I could convince a bunch of our clients who are against it to allow us to trade it, then never say never. But I don't think this is on the near-term horizon, next 2 to 3 years.
Fair enough. Thank you for coming to our studio.
Thank you for the opportunity. It was a great pleasure.
Thank you for listening to the i3 podcast. For more information, please visit www.i3-invest.com. Thank you very much.